Hi, this is Professor Karen Lin. Welcome to the Financial Accounting for Undergraduate Students. In this video, we are going to talk about the costing assumptions. We are going to talk about first in, first out, or FIFO, last in, first out, or LIFO, and average cost. These are all different costing assumptions that companies might use to determine the cost of goods sold. Let's get started. Let's first talk about the costing flow. So in the previous video for Chapter 7, we talked about two different types of companies, merchandising companies and manufacturing companies. So for merchandising companies, their inventories are mainly merchandise inventory. Those inventories are reported on the balance sheet. When those inventories are sold, they would become an item on the income statement instead, called cost of goods sold. We're going to talk about the relationship between inventory and cost of goods sold in a minute, but pay attention, the costing flow is floating from the balance sheet to the income statement. The same thing happens for manufacturing companies as well. The manufacturing companies would have raw materials, work in process, and finished goods. Once they are produced and ready for sale, they would be sold and flowing to the income statement. Here is the basic equation for the costing and the flows. So a company typically has beginning inventory, which means the inventory left from the last period. That number plus the purchases of inventory during the current period would equal to all the goods available for sale. So beginning plus purchases equals to available for sale. For example, if the company has 40,000 inventory left from last period, and the company purchased more this period, 55,000. Obviously, the company all in total has $95,000 of inventories for sale. Those are called available for sale. And let's assume the company sold $60,000 out of the $95,000 of inventory. Those $60,000 inventory sold, because the inventory is sold, it's no longer inventory, right? So it became cost of goods sold because it's sold. The rest remaining on the balance sheet becoming the ending inventory, which will become next period's beginning inventory, and the big accounting cycle starts again. So you will see beginning plus purchase equals to available for sale, and the available for sale can only go two directions. It could be either sold or it could be remained. There's no third method or third road. So the relationship we just talked about can be formalized in the equation that beginning plus purchase equals to available for sale subtracting ending inventory equals to cost of goods sold, or the other way around, available for sale subtracting cost of goods sold equals to inventory. Now, let's assume this is an example that we could apply the equation that we just talked about. So assume Harley-Davidson has a beginning balance of 40,000 and the newly purchased inventory 55,000. The company determined at the end of the period they have $35,000 goods left in their inventory. So what is the cost of goods sold? By using beginning plus purchases equals to available for sale, we can determine total available for sale is 90,000. 90,000 subtracting ending inventory 35,000. We know the cost of goods sold is 60,000. If you look at a T account for merchandising inventory, you will see the beginning inventory 40,000, purchase 55,000, ending inventory 35,000. So how do we start from 40 adding 55 becomes 35? It's because we have a credit side of 60,000. You can see this 60,000 is basically can be calculated from the T account perspective. So now let's talk about our inventory system. When we talk about inventory system, we are talking about how accountants are going to account for their inventory amounts. There are two ways the accountants could keep track of the inventory amounts. The first way is called the perpetual inventory system. Under the perpetual inventory system, accountants record every transactions of purchases, and those are directly recorded in an inventory account. And sales, when the inventory are sold, the sales are required to record it in the sales account, and in the same time, the accountant would also record the cost of goods sold for the amount of inventory that's been sold. Now, the sales account is the sales price multiplied by the pieces of inventory that's sold. The cost of goods sold is the cost of that sales. The difference between the two is the gross profit from the transaction. Another way to calculate or keep track of the inventory is called periodic. In a periodic system, the accountants do not keep track of purchases or sales. They don't keep track of their inventory at all during the period. But at the end of the period, they count their inventories. So when they count their inventories, they determine how, from the beginning inventory and the plus, so basically it's here. They know the beginning inventory, they know how much they purchases during the period, they count the ending inventory, they found the cost of goods sold. Alright, so now let's discuss cost of goods sold. How do we determine cost of goods sold if we are using, say, a perpetual system or periodic system, right? There are 3 ways, or there are more than 3 ways that accountants use. But in this course, we're going to only discuss these 3 commonly used methodologies. First in, first out, last in, first out, and average cost. So all these 3 different methods basically assume some form of flow of our inventory. For example, first in, first out assumes that whatever inventory we got the first, we are going to sell them the first. Now you can imagine what type of inventory are selling this in this way, right? If you are selling milk, you want to sell the first milk you get in, and then move to the later orders because it's perishable goods. If you're selling toilet paper, you might not care when you get the toilet paper, and you probably just fetch whatever toilet paper is closest to you, which might usually be the last batch of toilet paper you got from your supplier. So last in, first out could be those inventories that sold in the mass quantity, it's not perishable, and so on and so forth. Now, what I was just talking about is to help you to imagine or visualize how first in, first out, and last in, first out would work in reality. However, when we make our costing assumptions, now this is a key point you need to remember. When we talk about costing assumptions, we do not base our costing assumptions based on the physical flow of our goods, which means if you are selling milk, you can still use last in, first out in accounting. Okay, you may not sell them in the last in, first out fashion. You can use LIFO in accounting. That's why they're called cost flow assumptions. Alright, so in the next video, I'll show you how to use these different cost assumptions using an example. I'll see you in the next video.